99% of investors have misread America's real economic crisis. The booming AI sector is not the core risk. A decade's hidden debt storm is quietly triggering a global market collapse. Many people mistakenly believe that AI bubble is the biggest risk facing the United States right now. But this is not the case. The AI bubble is at most a trigger. The real powder keg full of risks is U.S. national debt. Let's start with a simple analogy. Suppose your monthly income is 10,000 yuan and your monthly spending is 8,000 yuan. Theoretically, your finances are stable with a surplus of 2,000 yuan per month. But if one day your income stays the same, yet the monthly interest alone on your credit cards, mortgage and car loan hits 8,000 yuan, the situation goes awry immediately. Note that this is only the interest payment, not a single cent of the principal. This is exactly the predicament the U.S. federal government is in today. In 2026, U.S. federal debt is approaching the $40 trillion mark. What does this mean? The U.S. annual GDP is roughly $30 trillion, which means U.S. debt has exceeded the country's total annual economic output. Most people cannot grasp the magnitude of $40 trillion. Let's break it down. With a population of 340 million, every American owes more than $110,000 in national debt on average. For a family of 3, the per-household debt burden reaches about $330,000, equivalent to over 2 million renminbi. Of course, national finances cannot be simply equated with personal finances. A sovereign state will not go bankrupt like an individual, supported by taxation, currency issuance, military power, and national credit. However, there is an immutable economic rule even the most powerful country cannot break. The growth rate of debt cannot outpace the growth rate of revenue in the long run. Over the past 2 decades, the U.S. has been relying on the same strategy, rolling over old debt with new debt. This model is common among companies and households, yet it hinges on one critical prerequisite: a prolonged low-interest rate environment. For example, if you owe $1 million at a 1% interest rate, the annual interest is only $10,000, which is barely a burden. But if the rate jumps to 5%, the annual interest surges to $50,000, multiplying the pressure 5-fold overnight. This is exactly the shift the U.S. has undergone in recent years, moving from a zero-interest rate era to a high-interest rate era. This has led to a widely overlooked key data point. Annual U.S. Treasury debt interest payments have surpassed the national defense budget, becoming one of the largest federal expenditures. Put simply, the U.S. government now acts just like an individual who keeps opening new credit cards to pay off old balances. Of course, the biggest difference between the U.S. and ordinary debtors is its control over the U.S. dollar. Many people think the U.S. dollar is just a currency, but financially, it is essentially a global trade license. The vast majority of global transactions for core commodities such as oil, natural gas, grain and chips are settled in U.S. dollars. This forces all countries to hold U.S. dollars, creating America's decades-long core advantage. While other nations borrow from banks, the U.S. borrows at the expense of the whole world. Thus, a decades-long stable economic cycle was formed. The U.S. issues debt, the world buys it. The U.S. consumes, the world produces. Dollars flow back to the U.S. to fund more debt issuance. Yet this flawless cycle has shown obvious cracks in recent years. If you track major central bank actions over the past 3 years, you will spot an abnormal and highly telling trend. Central banks worldwide are aggressively buying gold. China, India, Turkey, and Middle Eastern nations are all major buyers, pushing global central bank gold purchases to consecutive record highs. What is the core logic behind this? More and more countries are questioning whether the U.S. dollar can maintain its historical credibility as U.S. national debt continues to expand uncontrollably. Here is a crucial insight. America's biggest risk is never the total amount of debt, but the accelerating growth rate of debt. Debt itself is not terrifying. Out-of-control debt is the fatal crisis. At the time when U.S. debt risks keep accumulating, the AI track has risen rapidly. Many regard AI as a new hope for the U.S. economy, which is true. But at the same time, AI is also a huge gamble for the United States. The U.S. is desperate for a new growth narrative to sustain its economy. After 2008, the real estate bubble burst. Manufacturing industries shifted overseas on a large scale, population growth slowed, and productivity gains stagnated, with all traditional growth engines stalling. The U.S. urgently needs a new growth driver. Otherwise, its soaring debt will eventually become unsustainable. This is why AI has been crowned the new savior, just like the internet in the 1990s, automobiles in the 1920s, and railways in the 19th century. Massive capital is pouring into AI, industry valuations are skyrocketing, and data centers are being built at an unprecedented scale. The 7 major U.S. tech giants are engaged in the largest capital expenditure race in human history. Institutions predict that global investment in AI infrastructure will exceed trillions of US dollars in the coming years. The key phrase here is infrastructure. When an industry begins large-scale infrastructure development, it usually indicates 2 things. First, it is truly transformative. Second, asset bubbles have started to build up. The craziest phase in capital markets never comes when profits are realized, but when stories and future expectations dominate. During the 2000 internet bubble, many unprofitable companies boasted multi-billion-dollar market caps. At the 2007 real estate bubble peak, property firms with extreme debt ratios still saw skyrocketing stock prices. The AI industry is now in the exact same situation. Many AI firms have no stable, sustainable profit model, yet their valuations have priced in profits for the next decade or even 2 decades. So here comes the question. What if AI technological advancement and industrial development fall far short of market expectations? What if a $10 billion data center only generates $1 billion in profits? What if the actual utilization rate of expensive GPUs is far lower than expected? What if AI will indeed change the world, but over 2 decades instead of the 2-year breakout the market imagines? Once these expectations fail, the entire AI valuation system will face comprehensive repricing. And repricing is one of the cruelest words in capital markets. A mere 10% drop in corporate profits can trigger a 70% stock price collapse. This is why every disruptive technological revolution in history has been preceded by a massive capital market correction. It happened with railways, automobiles, and the internet, and AI will most likely be no exception. Yet the bursting of the AI bubble is not even the most dangerous part for the U.S. When the internet bubble burst, U.S. debt was low, leaving the Fed ample room for monetary easing. During the 2008 subprime crisis, U.S. debt was far smaller than today, allowing the government to bail out markets and banks. The current situation is completely different. The U.S. is already the world's largest debtor. Once the AI bubble pops, corporate financing will shrink, tech stocks will crash, fiscal revenue will plummet, and economic growth will slow sharply. Meanwhile, interest payments on nearly $40 trillion of debt are relentless and non-negotiable. At that point, the U.S. will face an unprecedented dilemma. Save the economy or save the dollar? If it cuts interest rates to stimulate the economy, it may prop up the market temporarily, but will trigger a resurgence of runaway inflation. If it raises rates to defend the dollar, it can preserve dollar credibility but will burst the AI bubble and trigger a severe capital market collapse. More critically, while the U.S. is trapped in this dilemma, another key domino has fallen, not in America but in Tokyo. For the past 3 decades, the world's largest source of liquidity was not the Fed, but Japan. And Japan is now ending its decades-long monetary easing experiment.